tonight, you're going to hear from Bob Prechter of Elliott Wave International. He called the bull market rally in stocks in 1980s as well as the correction in 1987. Find out why he thinks metal prices have peaked. Now, my next guest, he has warned subscribers back on Friday that metal prices had peaked. And with gold's decline today, that warning seems quite timely. Bob Prechter, CEO and founder of Elliott Wave International, is our guest, and he joins us now from Atlanta. Bob, welcome back.
Thanks for having me back, Pam.
Bob, so explain, why did you put out that call on Friday about a peak in metal prices? It seemed as though a lot of people were talking about continued fall of the dollar, and that was what drove the price of gold ever higher.
Right. One of the reasons is that it seemed like an absolutely sure thing. We track several indicators of sentiment. One of them is the Daily Sentiment Index, DSI. That reached 98% bulls on a one-day basis, 95% bulls on a 10-day basis going into this last high. So we've been paying very close attention to it. We were tracking silver as well and all the other commodities. And you know the history as well as anyone. In 2005, everyone said real estate is the answer. 2006 into early 07, it was stocks. And lately they've been saying commodities and precious metals. And now again, just like real estate, just like stocks, 90% bulls. Well, the chart I'd like to show here is of silver, because this is the one that was clearest in our minds.
And that is indeed being shown right now, Bob, just so you know. That's the silver trend line.
Okay, good. Yeah, we've got several factors that we saw on Friday. Number one is that silver soared right up to touch the resistance trend line that it's had now for 5 straight years. Silver's been going up for 7 years in a row. As I said, it's marked on there. We hit as high as 98% bulls. I don't believe there's ever been a reading higher than that. So you couldn't get much more lopsided than that. And finally, if our numbers are up on that chart, it was a very pretty Elliott wave picture with the right number of waves in it. Now, at the time on Friday, we needed one more. I said we should make one more slight new high. That happened Monday morning, and silver dropped 15%, and I think it was 48 hours. That's a heck of a reversal, and I think it's real.
Well, but Bob, let me ask you, what is the fundamental reason why you're seeing this sell-off? Is it people locking in profits? Is it people taking their money and putting it into treasuries? Where does that money go once they've actually made a sale?
Well, the beautiful thing about markets is they tend to do things when the fundamental reasons are completely missing and absent. There was no fundamental reason to buy gold and silver back in 2001 that I read anywhere, and now everybody seems to know why you should own oil and gold and silver. So usually the fundamentals are all telling you the wrong thing at the extremes. They may be in sync during the trends, but at the extremes they're all saying one thing. And as you say, on Friday there was every reason to believe the dollar was making new lows. The Fed was sure to cut by 3/4 of a point at least on Tuesday. Every reason to be long. Well, the market's perverse that way. It trades on its own waves, and it had enough on Monday morning.
All right, Bob, stay with us. We're going to come back and we're going to talk about some perhaps more perverse action in the bond market. We're going to talk about, were yesterday's gains just a bear market rally? Are investors wrong to think that financial stocks may have hit bottom? I'm going to ask Bob Prechter that. Also, we're going to talk about the Treasury market with him. I am back with Bob Prechter, the founder and the CEO of Elliott Wave International. Bob, speak a little bit about the trend that we've been seeing in U.S. Treasury yields compared to corporate yields. It seems as though we're almost entering this period where we're going to have negative yields on short-term dated paper. What is going on?
Okay, that was probably the biggest topic in the book I wrote called Conquer the Crash. Coming into this period, we're having an amazing thing that only happens once every 50 to 80 years. And that's when the debt bubble is so huge that interest rates begin to actually go in 2 directions. So just as happened in the 1930s, early 1930s, and again from 2000 to 2002, you're seeing the Fed lower interest rates. The yield on U.S. Treasuries is coming down, down, and down through the whole time. But what's happening in the other sectors? And the answer, of course, is they're going up. You've had soaring interest rates in subprime mortgages, for example, way, way up. which means they're crashing in price. Well, some of the other bonds, the corporates, and now the municipals are beginning to creep up in their interest rates. They're going in opposite direction from the treasuries. Why is that? Because we're heading into this period when we're going into a deflation. The lenders are way overdone, and people are looking for safety, and that's why they're choosing the U.S. governments, even though the U.S. dollar is making new lows every other week.
Well, what happens next, Bob? I mean, if you kind of follow the next perhaps illogical move, wouldn't corporations start to buy back their debt right now, try to replace it with lower cost debt as the Federal Reserve has lowered rates? Wouldn't that be the intelligent corporate thing to do for treasurers?
Well, I think one problem is that corporations are completely strapped, and just like all of these hedge funds and everything else, they have lent out, or they've got plenty of bonds out there. I don't think they can do the deal. I don't think the investors are going to give them up. And the investors actually are going to demand higher and higher rates. If we can show that second chart, I'll show you a little history about this.
It's right up there, Bob.
Very few people know about this. During the 1920s, the roaring 20s, when the stock market was soaring, the bond market was going up as well, and interest rates were falling throughout that period. Well, this is a picture of corporate bonds during that time. Now, look what happened on the right-hand side of the chart. This is from 1928 down to 1932-3. Bond rates for corporations soared, which means their prices collapsed. And this is while the U.S. Treasuries were holding up. That's what we're facing. So people, not only are corporations not going to be able to convert their debt to lower interest rates, investors are going to demand higher and higher interest rates from corporations and, I think, from municipals. That's going to be the next big surprise.
Well, but Bob, let me just press you a little bit on this, because there was news today about Caterpillar and Exelon, the utility, both going to the corporate debt market, marketing almost $6 billion of corporate bonds in order to take advantage of these lower interest rates. And it seems as though they boosted the size of their bond offerings in order to do so. So what does that say about where investors are willing to put their money if they have to boost the size of the bond offering because they can get people to buy it?
I think the issuers are very smart. I think they're on the left side of this curve, because down the road, another 6 months, year, 2 years, 3 years down the road, I think we're going to see these soaring rates, falling prices for all these bonds. And I think they're getting it while they can. There's still plenty of liquidity in the system. We have to remember, oil, gold, and silver, for example, just made new highs last week. So there's still a lot of liquidity around. It's tightening up. The banks are getting more conservative. But for now, the people with attractive deals, whether they sound safe like utilities and other things, are going to be doing okay. It's the fringe right now that's in big trouble, and it's a slow process. I think it's going to take us about 4 or 5 more years to get out from under it, and the most dangerous things are yet to come. So my key word is the same as always: safety. If you get yourself safe, you can relax. You don't have to play this game.
All right, then how do you get yourself safe, and what would you be recommending to people who want to invest money?
Well, the thing I've been saying all along is you want something that is, if you can buy bonds that will stay AAA throughout this whole period, that's what you want to do. But they're few and far between. It's very difficult, particularly ones in currencies that are holding up. The Swiss franc is kind of attractive, as always has been. I think you can go long U.S. Because I think the dollar is probably groping for a bottom here. The New Zealand dollar is very attractive, and they have an anti-inflation program in place there. It has been ever since 1984 when they revamped things. So there are places to go, and it's not the stock market, it's not the real estate market, it's not the commodities, and these are the places that everybody thinks they're going to be bailed out. And one more quick thing, there are a lot more interesting things about gold and silver to say, so if anybody didn't get a good look at that silver chart, they can just go to ElliottWave.com and they can get a good look at it. And they should study that, because there's more information there than you'll get from the fundamentals.
Bob, what about other precious metals, since you mentioned it again? What about platinum and so on?
Well, you know, I have to draw a line somewhere. I'm not a precious metals analyst. I've got a specialist who covers that. So, you know, you could even look at the base metals like copper and tin and lead, and they've had runs. So sometimes one can go one direction without the other one, but silver is usually the leader. I don't know if you remember 1987, but silver peaked early in the year. I believe it was April. Gold held up all the way to December. This time it looks much more like January 21st, 1980, when they peaked concurrently. I guess we'll have to come back in a few months and see.
All right. Well, thank you very much, Bob Prechter. We're going to have you back before a few months take place, because I'm sure these issues are not going away. Thank you very much, Bob Prechter of Elliott Wave International.